Assalamu alaikum class. Today we are starting a new topic and a new chapter, chapter number 9 from Financial and Managerial Accounting book written by Williams Haka Bettner. In this lecture, I will discuss about the cost of assets, how to calculate cost of assets, and the difference between capital expenditure and revenue expenditure. So the company purchased or acquired long-term assets that are used in the business or operations. So the cost is allocated over its useful life in order to calculate depreciation expense. Now, how to calculate the cost depends on the difference between capital expenditure and revenue expenditure. All the capital expenditures become the part of asset, part of the cost of the assets. There are three accountable events in the life of any assets. First of all, the acquisition of the assets means when you acquire or purchase the assets, then allocation of the acquisition cost to expense over the asset's useful life, which is called the calculation of depreciation expense. Means we allocate this acquisition cost over the useful life of the asset, and then sale or disposal of assets. So in this particular lecture, we are going to cover the acquisition process. What is the acquisition process? What type of cost should be added in the cost of asset, and what should not be added? So the cost of the asset comprises of three things. First of all, the asset price. It is the invoice price. Invoice price or asset price, or you can say the purchase price, which is given. Then we add all the reasonable and necessary cost. Reasonable and necessary cost for getting the asset to the desired location. Number one, for getting the assets to the desired location may be for a factory or any organization, any company. In this, we may take the example of delivery cost or freight charges or any import duties if we are importing the asset from abroad. Then this is the reasonable and necessary cost for getting the asset to the desired location. And number two, for getting the assets ready for use. For example, installation charges, installation of asset, installation of equipment or computer, or any testing charges are a part of reasonable and necessary costs. So these costs will be added to the asset price. Then we have the difference between capital expenditure and revenue expenditure. All type of assets related to the purchase of assets should be divided either into capital expenditure or revenue expenditure. All the capital expenditure become the part of the cost of the asset, or you can say we simply capitalize the cost. Capitalize the cost mean capitalize an expenditure means we add that expenditure in the cost of the in the acquisition cost of the asset. And revenue expenditure, their revenue expenditure are basically recurring nature expenses. These are day to day or routine expenses, and they should not be capitalized, or they are not the part of the cost of the asset, long term assets. So capital expenditure, any material expenditure that will benefit several counting period. For example, if you are installing a new engine in the car, then that engine will give you benefit for several accounting periods. So that should be capitalized. Similarly, any such expenses are part of capital expenditure that give the life, that increase the life of the asset, or that increase the working capacity of the asset, or number of units production will be increased. So that sort of expenses are called capital expenditure and become the part of the cost of the asset. Then the revenue expenditure for ordinary repairs and maintenance. I mean, these are the recurring nature, means yearly depreciation, yearly, you can say yearly maintenance, yearly insurance. So these are routine expenses. We To expense an expenditure means to charge it on an expense account. So revenue expenditures are basically expenses account, and we charge it separately, not a part of the asset, whereas the capital expenditures become the part of the asset. These are those expenses that become the part of the assets. So we are going to calculate, we are going to calculate the cost of the asset in the Excel sheet. Here it is, the Excel sheet, the problem. This is the brief exercise 9.1 from the book Financial and Managerial Accounting, uh, written by Williams Haka Bettner. Chapter 9, Plant and Intangible Assets. So this is the first lecture. In this first lecture, we will learn how to calculate the cost of the asset, and how to differentiate between capital expenditure and revenue expenditure. And we will cover three exercises in this lecture. So the lecture number one, we will extract important data. Petrin Corporation purchased a used piece of heavy equipment for $25,000. So $25,000 is the invoice price or the purchase price of the asset. Then delivery expenses or delivery cost is also given $750. The expenditure to recondition the equipment and prepare it for use, means reconditioning the equipment means this expense or this expenditure is necessary to put the equipment or the asset to use, to bring the asset in the usable form. So this is the necessary and reasonable expense, reconditioning expense. So this become the part of the cost of the asset. Then maintenance expense for the first year is also given. For the first year means this expense is recurring nature. So this expense is revenue expenditure. You will have to incur that expense again and again over the year, each year, maintenance or repair expenses. So this expense is not a capital expense. This expense should not be capitalized. The requirement is to calculate the cost of the asset which is used for computing depreciation. So we are going to calculate the cost of the equipment. So the first part is the purchase price. Purchase price, or you can say invoice price. So invoice price or purchase price is 25,000. Then the next one is delivery cost. It is also necessary or reasonable expense um, to bring the asset to the destination or the factory. So this should be the part of capital expenditure. So here we have delivery expense or charges, which are $750. Then we have uh, expenditure on reconditioning. So in simple word, we can say that reconditioning expense and reconditioning expense are uh, 2,230. So the total cost of the equipment are, we are going to add it, 27,980. So this is the total cost of equipment. Equipment. Here we have the answer. So we highlight it. Whereas the maintenance cost or the maintenance expense is maintenance expense is dollar 1,200, and this is separate. This is a revenue expenditure, so we write it separately as an expense, expense account. Maintenance expense, repair expense, monthly or yearly insurance expense, all these are revenue in nature. Revenue expenses are there. Then second example which we are going to do is exercise 9.2. This 9.2 is again the difference between capital expenditure and revenue expenditure. So the requirement is identify the following expenditure as capital expenditure or revenue expenditure. So we have just learned that capital expenditure, any expenditure that will benefit for several accounting period and that are necessary to bring the asset into usable form, whereas revenue expenditure are for ordinary repair and maintenance, and these revenue expenditure are recurring in nature. We use it again and again. So number one expense which we are going to discuss, immediately after acquiring a new delivery truck, paid 195 to have the name of the store and other advertising material on the painted on the vehicle. So this is one time expenditure. When you acquired any asset, and you have to pay a one time painting or paint expenditure, uh, paint related expenditure. So this become advertising material painted on the vehicle. So this become the part of the uh, asset. So you can say A is your capital expenditure. Capital expenditure. This is going to be add in the cost of the asset. Why? Because it is a new delivery truck and you are going to paint it first time. So this 95 here, how much amount is $195. Then B part, painted delivery truck at a cost of 450 after 2 years of use. So remember, whenever you purchase first time any asset or a new asset and you paint it, then this becomes a capital expenditure as in case A. Whereas in case B, you can see that again painted that delivery truck but after 2 years of use. So after 2 years of use, this become revenue expenditure. So this 450 represent revenue expenditures. Whenever you use any asset for several years and then you paint it, then this painted expense become revenue expenditure. Then the third one is purchase a new battery at a cost for $40 for 2 years use 2-year old delivery truck. Again, because you have used that asset for 2 years, and new battery is basically necessary for routine use of delivery truck. The new battery will not increase the life of the delivery truck, or the miles per hour, or the running capacity, but battery is necessary for routine working or for maintenance working. So this cost is the cost of the new battery is, you can say this is for revenue expenditure. Dollar 40. If in C part, if this was a new truck, you just if it was a new truck, then this battery would be a capital expenditure. But in this case, as the delivery truck is 2 years old or 3 years or 5 year old, then the battery installation of a battery is basically a revenue expenditure. Then the next example: install an escalator at a cost of 17,500 in a in a three-story building that had been used for some years without elevators or escalators. So this elevator or the installation of this escalator basically is going to increase the cost of the building, because this escalator is one time expense. It is one time expense, it is not a recurring in nature, and this will increase the you can say earning capacity or working ability of the building. So this installation charges will become this installation will become the capital expenditure. Capital expenditure means this 17,500 is going to be added in the cost of the building. The next example is purchase a pencil sharpener at a cost of $15. So first of all, the pencil sharpener is basically a stationary item. It is, you can say, current assets, and the amount of the pencil sharpener is $15, which is too small to capitalize. So we classify it as revenue expenditure. So the purchase of a pencil sharpener or any stationary item becomes uh, revenue expenditure. The last example, we are going to read it. The last example: original life of the delivery truck has been estimated 4 years. Straight line depreciation method is used, which is 25% yearly. After 3 years of use, however, it was decided to recondition the truck thoroughly, including adding a new engine. So if you are going to add a new engine, the new engine will increase the working capacity of the delivery truck. So any such expenditure which increase the working capacity of any fixed asset, then this should be capitalized. So this become the capital expenditure. um, New engine, adding a new engine or reconditioning the truck is basically an example of capital expenditure. So that's it. This example shows the difference between capital expenditure and revenue expenditure. We are going to complete one more example, one more problem, and problem is 9.1a. So 9.1a, here it is. In one sentence, first requirement is in one sentence, make a general statement summarizing the nature of expenditure that qualify for inclusion in the cost. Inclusion in the cost of the plant assets such as computing equipment. So, at the start of the lecture, we have just discussed the difference between capital expenditure and revenue expenditure. And we have also discussed one more thing, that any reasonable and necessary expenditures in acquiring the asset and placing it in a position and condition for use. So, all the necessary and reasonable expenses are a part of, you can say, the cost of the asset. So we add the cost of the asset, or we, in other word, we capitalize such assets. So that is the answer of part A. In part B, they have asked, for each of the six numbered paragraph, indicate which items should be included by Wilmette College in the total cost debited to the equipment. Also briefly indicate the proper accounting treatment of those items that are not included. Means we will have to differentiate, first of all, the capital expenditure and the revenue expenditure. Capital expenditure means those expenditure that become the part of the asset, the part of the cost of the asset. And the revenue expenditure are those expenditure that are not be included in the cost of the equipment, and we will discuss the accounting treatment of all such items. So first of all, we have capital expenditure, and then we have revenue expenditure. Number A example, or you can say one. In one, the list price of the equipment is dollar 275. However, Wilmette College qualified education discount. So total price of the equipment was 275, whereas the company got $25,000 education discount. The company paid 50,000 cash and signed a 3-month 9% note payable for the remaining balance. This note plus accrued interest charge was paid promptly at the maturity date. Maturity date means after 3 months. So first of all, we have a list price of the equipment is 2,75,000. Then we deduct education discount, which is $25,000. So the total cash payment for the purchase of the asset is 2,50,000. 2,50,000. And then here the company paid. So company paid cash. Accounting treatment, we have a debit column, we have a credit column. The company purchased equipment, so equipment is basically debited by 2,50,000. We are going to, okay, here just revenue expenditure. We will discuss the treatment of revenue expenditure. So it paid 50,000 cash, means this is the payment of the purchase of equipment. Equipment will be debited by 2,50,000. The cash will be credited by 50,000, and the notes payable will be credited by remaining amount, that is 2 lakh. So this is the accounting treatment of that capital expenditure. How the entry would be: equipment will be debited, will be on debit side by 2,50,000. Then we paid cash. So cash should be on the credit side. How much we paid cash? 50,000. And then the company sign a note for the remaining balance. So notes payable is how much remaining, means 2 lakh is the remaining amount. So this would be the accounting treatment of the asset purchase on this date, first on the first example. The interest will be accrue on maturity date. So this will be recorded, and this interest expense is a revenue expense. Interest expense is the revenue expense. This will be recorded on the maturity date. Right now it is not due, so the company will not record it right now. In the next second part, in addition to the amount described in part 1, Wilmot paid sales tax of 1500 at the date of purchase. So the sales tax is a mandatory tax. Company will have to pay that tax in order to acquire the asset. So this sales tax is a capital expenditure. Sales tax will be added in the cost of the asset. Here, the amount of sales tax is 15,000. We are going to add it. Then freight charges for delivery of the equipment. Again, you cannot you cannot bring the asset to the destination or to the factory without paying delivery charges. So delivery charges are the necessary expense or reasonable expense or mandatory expenses that should be capitalized. Freight charges is the capital expenditure. How much amount is there? $1,000. Then fourth one is the installation cost related to equipment. Again, this is the installation cost is necessary in acquiring the asset and placing the asset in a position and condition which is necessary for use. So this should be capitalized. So installation charges become the part of the capital expenditure, become the cost of the asset, which is about $5,000. So $5,000 is here. Then the entry number 5: during installation, one of the computer terminal was accidentally damaged by a library employee. It cost the college $500 to repair this damage. Now, this damage is not a necessary or mandatory requirement to install the computer. So, this is, you can say, this is a routine or you can say a repair expense, routine expense, and it shouldn't be capitalized. It should be recorded as revenue expense. So all these such damage cost, or you can say repair expense. So This is going to be record on expense side as repair expenses by, because expenses are recorded on debit side, so we debit it by how much amount? $500. So this is the repair cost. Then six one, last point, as soon as computer were installed, the college paid 4,000 to print admission brochures featuring the library's new state-of-art computing facilities. So now see the difference between this example and the last example. In the last example, the delivery truck was painted, means painting was on the delivery truck. Whereas in this example, these are separately printed brochures. So this is basically a revenue expenditure, or you can say marketing expenses, and all expenses are debited. So we are going to debit it. This is the recurring in nature, and this is called a revenue expenditure. So this was requirement number B, where we discuss in detail the treatment of capital expenditure and revenue expenditure. Basically, capital expenditure are all those expenditure which are going to be capitalized or become the part of the asset. Requirement number C is to compute the cost debited to the college computer um, equipment. So, in requirement number C, we are going to calculate cost of equipment. So, all the expenses that we have capitalized, means this cost and all these expenses should become the part of the 2,71,000. So this 2,71,000 is basically the cost of the asset, the cost of the equipment. This cost include not only the list price minus any discount, but also all the expenses that are necessary and that are reasonably necessary in order to acquire and place the asset into usable form. So the cost of the equipment is 2,71,000. The next and the last requirement is prepare a journal entry at the end of the current year to record the depreciation. Now we are going to calculate depreciation of the equipment, and this equipment use the straight line method and half year convention. Half year convention means we are going to divide the complete year depreciation into half over a useful life. So useful life are 5 years and residual value is zero. Part D. Cost of the equipment, annual depreciation. We can calculate annual depreciation by cost minus residual value and whole divide by useful life. So the cost we have just calculated 2,71,000 minus residual value, because there is no residual value here. It is given, assume zero residual value. So zero is the residual value, divide by useful life, which is 5 years. Here 5 years are given. This one, life, 5 years life. So life is also given. So the annual depreciation would be 54,200. But here half year convention is mentioned. So the depreciation expense would be 54,200 divided by 2 because a half year convention is mentioned here. So whenever half year convention is mentioned, a yearly depreciation will be divided by 2. So this is the answer of requirement number D. So that's it from this lecture. Please share, like, and subscribe. And in the next lecture, we will discuss depreciation methods. Two depreciation method in lecture number 2, straight line method and declining balance method. Whereas in lecture number 3, we will discuss unit output method. So that's it, class. Take care.